a big discussion here because earnings season is very much getting into full swing. And Lindsey, perhaps we'll start with you. How are the general themes shaping up now that financials make up the bulk of this early reporting season?
Well, I think the financials set a positive tone for the market for the rest of Q1 earnings season. Even though the results have been a little bit mixed, they confirmed what we had expected, that numbers have been cut just way too sharply going into this earnings period. On January 1, we were looking for 5% positive earnings growth for Q1. Now we're looking for a 2.7% decline. That's the sharpest cut in earnings that we've seen since Q1 2009, when the economic environment was extremely different.
You know, Erin, it's interesting because Lindsey has been with us a number of times over the past few months. I remember having this conversation at the end of kind of December, early January, when we talked about how the expectations have come down so much just since October for this earnings season. So is it playing out that this is going to be a good thing because the bar is just so low it's easy to get over?
I mean, it's potential. The one thing that I've seen that is concerning is that the revisions haven't stopped. So we keep seeing downward revisions, and we haven't seen that catalyst and change. And admittedly, we're still very early in the earnings season, but the fact that we keep seeing not only this quarter, but the entire year's earnings being revised down, and so, you know, some of the earnings are being pushed into fourth quarter, but you just haven't seen that bottoming of earnings revisions where you see a stabilization. So yeah, financials beating earnings in the first quarter is good, but I'm looking at the broader general market, and I'd like to see where we could at least stabilize our earnings expectations for this year and not just wait for all the positive news to come in 2020.
Lindsey, how important are the financials to the overall market narrative right now? I mean, we're a stone's throw away from record highs, and financials have not exactly been the leadership that has been getting us here so far.
Yeah, I mean, you'd like to see financials definitely play a role in the market because they are a large portion of the S&P 500, but they're also a great sign of the consumer and business sentiment. And the consumer is really strong. I think you've seen with some of the bank earnings, the consumer business is doing well, and I think you'll hear more about that today from Bank of America. But the other component of the business is really that corporate side where loans and commercial loans haven't picked up yet. And we need to see that. Corporate CEOs are really still a little bit, holding off on that investment.
So what's interesting, Lindsey brings up a good point about the consumer. We focus so much on banks like Wells Fargo, JP Morgan, Citigroup, Bank of America, but it's the regional banks that may give us a better view about what that consumer health is in the U.S. What exactly would you be looking for then in those regional banks who have yet really to report in earnings?
Yeah, well, we have heard from PNC,
right,
and of course we've heard from the Chase aspect of JP Morgan, and Bank of America will be able to give us that sort of insight as well. But I do agree, and it's a really important point. And again, I go back to the themes so far. If you do consider Wells Fargo as the one-off in that space, then the picture from JP Morgan, PNC, and Citi's U.S. retail business has been pretty good so far. Credit quality is still pretty good. Loan growth has been sort of fine, and it's kind of been broad-based on that kind of aspect of the U.S. economy. Bank of America, judging by what Brian Moynihan told me a couple of weeks ago when I interviewed him, albeit in quiet period, I think they could do pretty well, again, on that front. And just going back to the other part of the discussion there, yes, I think banks have beaten EPS for the most part, but it is kind of a similar setup to how we were last quarter, 3 months ago, which was low expectations. We'd beaten those expectations, but it still didn't lead to share price outperformance in the following 3 months because investors, for whatever reason, late in the cycle need to see blowout beats for them to really turn the corner on their sentiment towards banks. We probably haven't seen blowout beats. So
Erin, Wilf brings up an interesting point there. The U.S. does look pretty darn good compared to everybody else. Does that mean that this is still a good time to be investing and putting money into the market?
Certainly, we're a little concerned that valuations are getting a little rich for the U.S. large caps. But when you look at just, its relative attractiveness, yes, it is definitely your safest bet. I would say specifically with banks, the banks were the darling at the beginning of last year and the beginning of the year before, and they still disappointed and underperformed the broader market. And we might see that again this year. That I would say the focus on the consumer-focused stocks, like your Citi, your Wells Fargos, those might be the ones that have a better chance of outperforming for this year.
All right, the last one to you, Lindsey.
I would just add to that, I think when you think about the banks, the reason that we saw weakness yesterday was the top line weakness. And what you need to see from the banks is net interest income increasing. And in a rate environment where the Fed is turning dovish, not going to get very many more interest rate hikes, that's going to be much more difficult. It's got to come from loan growth, and it's got to come from investment banking fees.